Welcome to the Transparent FX Academy. I'm Nick and I'm a top author trading with over 190k reputation points. In this video, I will be speaking about EURUSD. Now, as usual, to keep the video as educational as possible, first I will be covering the technical aspect for this market. Then we will be moving to the order flow by looking at the commitment of traders, so the COT data, so essentially what hedge funds and the big players in the market are doing and how they're shifting their orders. And by the end of the video, by using a combination of these two different types of analysis, we will try to understand where we have the highest probabilities for the next potential move here for this pair. So this is definitely a video you do not want to miss. If you're new to the channel, make sure to subscribe. This is the place to be for high quality free trading education. Now, without further ado, let's jump straight onto the charts. Starting here from the monthly time frame, what we can see is that at the moment, from a monthly perspective, we have a market which has tested a very strong monthly support and demand area. From here, in fact, multiple rejections to the upside have been created. Every single time that the market tested this zone, it created a reaction away from the area, respecting it as support. And what we can see is that just now, here at this level, the market has tested once again this exact same level of support and demand, already started rejecting it to the upside. So in a situation like this, more bullish price action could be expected, as already happened in the past, when the market tested this exact same level of support and demand. So let's keep that in mind and drop on the most recent price action. Now, the pattern that we can notice here in this recent price action is the creation of an inverted head and shoulders, with the left shoulder here, the head here, and the right shoulder here. We can also notice that from a pattern standpoint, we have a clear impulse followed by a correction. And in general, after an impulse, if you want to measure the correction, you have to take your Fibonacci from the low to the high of the impulse leg. And if we do that, we can see how we have the 0.618 and 0.786 Fibonacci retracements lining up exactly inside of this level of support and demand, therefore creating a confluence of support and demand, having both Fibonacci levels and the horizontal support both lining up in the same area of price. And when you have confluence of support, you have an increased probability of getting institutional longing. And if you get institutional longing, that further increases the probabilities of a potential rejection to the upside away from a confluence of support area. And we will be speaking about institutional longing in few minutes when we move to the commitment of traders analysis to see what the big players are doing. For now, let's keep this in mind and let's drop down on the weekly time frame. Now, from a weekly perspective, what we can notice is that this level is quite important structure from a weekly standpoint. It was acting, in fact, as previous resistance here, preceding this rejection to the downside. Then the market broke above that zone, and that previous resistance was turned support here and was respected as support here. Again here, tested as support and respected. Again here, and right now, the market is testing the exact same level. So there is a good probability of getting a potential rejection to the upside away from this weekly support and demand area, which at that point would also reject the monthly confluence of support, which we have just identified. Dropping down on the daily time frame, what do we see? Now, from a daily standpoint, what we can notice is that in creating this move to the downside, the market has just printed this overextended M pattern. And in general, after the creation of an overextended M pattern, what you would expect is a potential rejection to the upside, with the completion zone being at the 0.32 of the Fibonacci taken on the impulse leg. So in this case, the impulse leg would be from this high to this low. Therefore, there would be a first potential upside target at this 0.32 of the Fibonacci taken on this impulse leg for the completion of this overextended M pattern. That is how most of the times this pattern plays out. And keeping in mind that also on the monthly and weekly, all this area is support, there's an increased probability of a potential rejection to the upside completing this overextended M pattern. Now, if we go and see what we have when it comes to the commitment of traders, so what hedge funds and the big players in the market are doing, and when we check the data precisely for the euro, what we can see is that with the last reports, there has been a huge shift from a negative net positioning back to a positive net positioning. In fact, institutions went from having minus 9.9k net positions all the way up to having plus 67.8k net positions, showing how institutions have shifted back to the bullish side for the euro. And keep in mind that if you're looking at the data for the euro, you're actually already looking at euro USD because all currencies on the spot are traded against the USD. And we can notice, in fact, 4,300 longs added from an institutional perspective just with the last report on euro USD, and 5,900 shorts getting closed from an institutional perspective on it. So clearly, hedge funds are moving back to the bullish side for euro USD, according to the data that we are reading here. Therefore, let's keep that in mind and move back to the chart. Now, by the way, if you still haven't, make sure to join my free Telegram channel, which you find both on the screen and also linked in description, so you never miss new updates. Now back to the analysis. As I was saying, from a daily perspective, the market has this overextended M pattern, and all this area is support, as we have already noticed on the monthly, weekly time frame, actually confluence of support. So since institutions are already adding longs, this increases the probability of getting more institutional longing inside of this area. So what would I expect in a situation like this? Well, as usual, trading is reactive and not predictive. The monthly, weekly, and daily timeframes combined with the COT data, those are the best timeframes when it comes to the directional aspect of the market. However, when it comes to identifying early shifts in the trend of a market, the best timeframes for that are the intraday timeframes, so 4 hour and lower. Therefore, what I would expect is that if this market would shift from an intraday bearish to bullish market at that point, I wouldn't be surprised to see a potential rejection to the upside away from this area, completing this overextended M pattern at the 0.32 of the Fibonacci taken on the impulse leg. Now, if you want to learn more, I really suggest that you go and check out the transparentfxtrading.com website, which you find linked in description. From here, in fact, you will have the possibility to gain access to my entire courses. You will also have the possibility to gain access to one-on-one live private mentoring directly with me, the VIP market breakdowns with the Telegram signals, the COT data software, which is precisely the one that we used in this video, the trading station software, which puts together everything that you need as a trader all in one interface. And if you continue to scroll down the website past the testimonials, you will see that you have the possibility to join and gain automatically access with email and password that you will create during the sign-up process. So I really suggest that you go and check it out as soon as possible. The link is in the description, and I will see you in it. If you enjoyed the video, make sure to drop a like and also let me know in the comments below any new pairs or topics that you would like me to cover in the next videos, and I will see you in my next breakdown.